Today's lecture deals with computing salvage value, or specifically net salvage value. And this is one of the more commonly missed topics or problems on capital budgeting in VINA 3000. The goals for this unit are fairly straightforward. First, we want to understand the difference between a market value and a book value. And here's what it is. Market value is what somebody will pay for something. It's its value today. Book value is an accounting value, or it's an asset's historical value. Our second goal is to understand the concept of a depreciable basis and how to calculate accumulated depreciation. Depreciable basis is simply what you paid for an asset plus installation and delivery, and accumulated depreciation is how much depreciation you've taken up to this point. Finally, we want to learn how to calculate the taxes that are owed or credited when we sell an asset. And we want to put this all together to get the net salvage value. Well, first, an asset's net salvage value is its market value minus any taxes that we have to pay or any tax credit we receive. So simply, net salvage value is the market value of the asset minus the taxes paid on the sale. Market value is sometimes called scrap value as well. Our next idea is we need to compare what we can sell the asset for versus what it's worth on our books. We're taxed on the difference between market value and book value. Now, sometimes market value minus book value is a positive number. That means we pay taxes. Sometimes it's a negative number, which means we can write off the loss on our taxes and actually get a tax credit. So two situations here. So if a firm expects that the market value is less than the book value, that means we haven't taken enough depreciation, and we can write off the loss on our taxes and actually end up with a credit. So we get a cash flow out of it. If our market value is greater than the book value, then we've actually taken advantage of depreciation to too great an extent, and the government will tax us on the gain when we sell the asset. So basically, they're going to tax us on the difference between the market value and the book value. Here's our full formulas for this. We start off with the top with just our simple idea of net salvage value equals market value minus taxes. Our second line is how we calculate the taxes. We simply take the capital gains tax rate and we multiply by the difference between the market value and the book value. This difference is often called the capital gain, or capital loss if you lose money. Substituting T in for the tax rate, now we write out our full formula on line 4. It's the market value minus the taxes, where we get the taxes by taking the tax rate times the market value minus the book value. Well, how do we get book value? From an accounting point of view, book value is really just the net PPE for an asset. It's the depreciable basis minus all accumulated depreciation up to that point. So I have an example here. If we sold after holding an asset for 3 years, we would need to subtract 3 years of depreciation off the depreciable basis to get the book value or the net PPE for an asset. Let's do an example. A pharmaceutical company, Healthy Potions, has bought a machine that produces pain reliever medicine at a cost $2 million 5 years ago. That's your depreciable basis. The machine has been depreciated over the last 5 years, and the current book value is $720,000. So that's like your net PPE. That's what it's worth on your books or its accounting value. The company decides to sell the machine now at its market price of $1 million. That's your market value. Marginal tax rate is 40%. What is the cash flow from selling the machine? Well, our market value is $1 million and our book value is $720,000. We know that. We compare those two numbers to determine the tax burden. When we take $1 million minus $720,000, that's actually positive $280,000. So we're gaining from selling this asset, and we will be taxed on that gain. With a tax rate of 40%, we're going to pay taxes of 40% of $280,000, which works out to be $112,000. So our final calculation is the $1 million we sell the asset for minus the $112,000 in taxes. So remember, it's all about what do we net when we do capital budgeting. And our net cash flow here is $888,000. Now this can be a difficult concept. So there's a few homework problems I've assigned that follow this concept specifically to hopefully strengthen you up when it comes time to test this.